Hello and welcome everyone to the last video update of the year from Endeavour Asset Management. You have myself, Dan Gafforini and Joe Carlton on the video today. First of all, just recent update on performance. We just passed through our 14-year milestone at Endeavour. Long-term numbers are between 10.8% per annum and 11.8% per annum versus your Lord's 8.9%. So over time, since we now have a longer track record, these numbers really start to compound. And you can see the total returns for clients since day one are between 320% and 380% compared to the All Lords 234% over the same period. November was a good month. We delivered between 5 and 8% for balanced growth and high conviction. All Lords was 4%, and you can see the rolling years are looking healthy, 27, 30 and 33%, All Lords 24%. Now, we thought it was specifically worth pulling out the high conviction portfolio. I took over as portfolio manager a year ago. Fortunately, that was a great time to take over, along with Joe and Dan helping manage this portfolio. It was around the low in the market. The All Lords has bounced 23.5% since then. The Small Lords up 20%, and this portfolio is up 33%. So great to return this portfolio to a period of outperformance. And based on what we're seeing in the market, we think this continues. The job is not done until we claw back to the highs and beyond, and we're confident we will do that. What are we seeing in the market? The fundamentals of the global economy are improving. There's no doubt about that. We've got the inflation shocks behind us. We'll show a slide next why it's clear that inflation has come back to normal levels, but we can't declare victory yet. There's some signs that it might be ticking up a little bit, which we're watching closely. We're seeing a step change in technology with AI. We expect the benefits from AI and work to emerge quicker than past innovations like the internet and mobile. ChatGPT, for example, had 100 million users in 2 months, and the fast-moving management teams, which we like to invest with, are seeing significant improvements to productivity and cost out from AI. And eventually the rest will follow suit because it makes a lot of sense, especially in a country like Australia. We have high labour costs. We're a relatively unproductive economy. There's massive costs out coming over the next few years. At the moment, we're seeing real incomes grow at their fastest pace in 20 years. Credit growth starting to inflect higher. China is stimulating. They're keen to not just stabilise home prices, but also direct incremental savings away from housing into equities. They're stimulating with fiscal policy, and as of this week, also monetary policy for the first time since the 90s. Trump is a big factor for markets. We've had a regime change the last month. We're seeing this is a pro-growth market. Trump is a capitalist. Love or hate him, let's disregard his personality. His policies are supportive for growth, supportive for earnings. We'll see more stimulus. We'll see deregulation. It's a pro-crypto environment. It suits certain particular stocks, and we are quite encouraged by early signs with the team he's building around him. So in summary, with the current market, and there is a lot more detail to run through, but what we're seeing is a good environment for equities, especially our hunting ground, quality growth stocks. This is what I was alluding to earlier. This is just the global core inflation. We're now within 0.5% of where we were pre-pandemic. So this is a remarkable decline. And for once, well done to the central bankers. They've managed this decline in inflation without causing a recession so far. And while some are declaring the battle won, it's always still worth watching. Recent data has seen inflation steady. There was a little uptick. It's stabilized. Australian inflation is proving stubborn. So we're watching for any signs of accelerating inflation. And if that occurs, we'll position the portfolios accordingly for a higher inflationary environment, a bit more defensive, a bit more high cash. At the moment, we're comfortable. This is the CPI in Australia and the US. Australia red, US grey. Just what I described before. We can see it's sort of flatlined recently in the US. Not in this chart was the inflation data last night, and there was nothing concerning there. That was in line with expectations. A few other dynamics that we're seeing, just 2 slides before we get into a few stocks. There is the divergence between small caps and big caps, there is a wide gap, and this gap is starting to close. So in November, we saw the Russell in the US, which is a small cap proxy, outperform the NASDAQ by 5.7%, and there's still a significant period of catch up to go. Locally, the Small Ords hasn't kept up with the All Ords, both on a 5-year view. And once we zoom into November and December to date, we expect this gap to tighten over the next 12 to 24 months. And there are good opportunities in some smaller, high quality, high growth companies, a few of which we own in the portfolio. This is how we're positioned. So you can see the All Ords in yellow and our portfolios in the 3 columns to the right. So the standouts here are we're underweight financials. And we've had a reasonable year. We've been significantly underweight the big 4 banks, which have ripped higher. We're also underweight materials, real estate, staples and utilities, and we have a higher cash weighting between 10 and 15%. It's hovered around 15% this year. So we've performed with a lower market exposure, a bit lower volatility than the index. What are we overweight? Quality industrials, quality technology, and consumer discretionary. We'll discuss a few of these ideas later, and also some healthcare. We're overweight communication services. This is mainly due to one quality telco super loop, and we also have Telstra in the portfolios. Over to you, Joe. Do you want to have a talk about smart parking, one of our highest conviction ideas?
Yeah, sure. Thanks, Hayden. So smart parking, as many readers of our newsletters will know, has held the top position in the high conviction portfolio for quite some time, for most of this year, in fact. And that sort of reflects our confidence in the business model since we've owned the stock. We were initially drawn to the company's ability to deliver solid returns on invested capital, coupled with robust revenue growth and high margins. And since our investment, which was in the low 40 cents, the company's financial performance has been remarkable, driven with the addition of new parking sites, which have significantly bolstered revenue growth. These sites, representing car parks, which smart parking deploy their technology at, are critical to driving revenue growth. Pleasingly, last month's updated guidance was to double the current 1,500 car park sites to 3,000 by December 2028. We see this as a welcome development. We're excited to see smart parking continue to expand its global footprint, and given the company's impressive 32% EBITDA margins and 36% forecast EPS growth, we think the current valuation multiples are attractive.
Lock is a compelling investment opportunity. We think it's poised for a big 2025. It's got an untapped market, high growth potential. For those who don't know the business, you might be familiar with Afterpay. They acquired Afterpay for $40 billion in scrip in 2021. It's got tailwinds supported by the current market regime, pro-deregulation, pro-crypto. This will support earnings growth, especially for a fintech like Block. Block is trying to close the loop, they say, in fintech. So when you spend in a store, most transactions go on the Visa and the MasterCard rails. You pay a fee to Visa and MasterCard. Block, they have the Cash App where you tap the little white square block to pay. Say in a cafe, for example. Once the money goes into their system, it stays in. They can pay service providers, they can pay debts, staff, employees, manage their tax without it going on the rail, out on the MasterCard and Visa rail. So it's a high margin setup and network for Block. It used to be expensive. It's now on a less demanding multiple. It's around 16 times, believe it or not. But this does not include the scrip payments for employee entitlements. Their earnings are forecast to grow at 23% annually for the next 3 years. Not included in this chart is we actually just took some profits the last 3 days because it's a high weighting for us, but we're confident about the next year for Block.
Oh, quickly chat on EML. So we discussed EML in the July video presentation, and we've owned it since March following their restructuring, basically through that process. Over that time, we basically cautiously increased our holding on continued share price weakness, whilst the market had basically been writing it off. They saw this business as a 3% per year revenue growth type business. We saw it as something much greater than that once they actually came out with their 2.0 version of what the business would look like over the next 5 years. They reaffirmed FY25 EBITDA guidance, coupled with new FY28 targets that showed that the board and the management team were confident they could re-enter a profitable growth environment following the rebuild. Management's now guiding a 10 to 12% revenue growth per year, so significantly more than the 3% the market was previously assuming. And we think that weighting is probably going to be back towards the FY27 year onwards. Although there might be a short-term decline in EBITDA margins as they sort of build up that sales function, we think that the 35% target they've put out in the market could actually be a little bit conservative. The share price increased 47% following the AGM, where they revealed that EML 2.0, and that was our largest contributor during November.
Premier Investments.
Yeah, so this is one we recently reinvested into, drawn by the potential returns stemming from the breakup of the PMV businesses. To recap, many will be familiar with Solomon Lew. This is one of his vehicles. And Premier Investments is a diverse portfolio of retail chains, including PMV-owned apparel brands businesses, Smiggle, Peter Alexander, a 31% stake in Myer shares, and a 25% stake in Breville shares. Shortly after our investment at 34 a share, a merger was announced between the PMV apparel brands business and Myer. We like the headline deal metrics, and we think that Solomon Lew's leadership could be instrumental in unlocking a potential turnaround at Myer. We're optimistic about Premier and calculate a sum of the parts valuation that is around 30% higher than the current share price. We've also heard a steady stream of positive economic data that further supports the thesis, including strong local retail sales data.
Yeah, it's a good point to finish there with, Joe. The recent retail data has surprised to the upside. Looks like the consumer's in better shape than some had predicted, and we have rate cuts ahead of us as well. So there should be a high disposable income, and it's one of the reasons we think Premier is a good investment. Next is Bravura Solutions, which was a new position for us in the high conviction portfolio in November. For those who don't know Bravura, we've owned it on and off over the years. We recently just reinvested. It provides software and services to wealth management, funds administration, life insurance industries around the globe. They've got a good operating model because the customer pays for improvements to the software. They bill for those, and then they release them to all their clients. So they create value that they don't have to pay the R&D expenses for themselves. They've been through a restructuring period in FY24, and they've worked on reducing the cost base relative to the revenue line. Luckily, we bought this the day before they upgraded FY25 EBITDA guidance. So when they came out with an announcement, demonstrated the business is back to growing revenue at a sustainable rate, which was a positive surprise to the market. And this has led to significant operating leverage and EBITDA margin expansion. And we think this operating leverage and profit margins continue to expand. This could go up to 18% in FY26. Now, even though we have a positive outlook, as clients will know, we tend to take profits into share price rallies, and we took a little bit off. It was a high weighting for us. We started at 4% in the high conviction. It popped to 20% the day after. So we've just taken some profits there. We've taken it back to our target weighting of 4%.
Thanks, Hayden. Hansen, we bought Hansen in July 2024, and we previously talked about in the July newsletter the same month. At the time, we were basically able to purchase our holding at an average of about $4.50 per share. We expected that it would offer good risk reward over the next 12 to 18 months, purely based on what was a short-term issue. We saw a situation where a highly capable management team with a strong track record of successfully acquiring, integrating acquisition targets had been really understood, heavily discounted, and as a result, the share price just had no buyers. Hansen acquired a loss-making German business, and that was very well known to management team that already operate in that region. So we thought that they would pretty much do what they've always done and successfully integrate it. They just need a little bit of time to do it. The August reporting season was a great example of how misunderstood the business was. On the morning of the result, the share price actually initially dropped by 5%, and about 10 minutes later started going up. And by the end of the day, ended up 17% over that whole day. on that day we were increasing our position because it was just such a misunderstanding of basically the entire situation. With all that said, we exited Hansen mid-November as it reached our preset valuation target of around 560, and we'll just keep an eye on it to see if any weakness comes back into the share price over the next 12-18 months.
So that's it for a few movements in the portfolio and some of our key ideas going into next calendar year. Obviously, a lot of work goes on behind the scenes. If anyone wants to talk about any of these in more depth, happy to chat anytime, as always. Now, the outlook for the next year, sort of as we said in the intro, the global macro conditions of equities, we were positioned for an uplift in growth, and this is starting to materialize. And now the macro environment's improved even further, strengthening the case for equities. Quality companies, we're confident that the companies we own will always perform well, and we don't get them all right. We hope we can cut the ones that we don't get right quick and early. And we believe the companies we own are well positioned for strong performance in the coming year. We're also witnessing a small cap revival after years of underperformance. We believe there's a significant opportunity in smaller companies over the next 3 years, of which we can get into all three portfolios, the growth balance and the high conviction. As per our mandate, we can go anywhere in the market. So we're ready to capture these opportunities as they arise. However, we're always mindful of the risks, whether it's geopolitical tensions, interest rate guidance, higher inflation data. There's always something to watch. These risks are always bubbling along. The important things to figure out which ones develop into a real risk or which ones don't. And if these risks escalate, we'll act quickly. We'll shift the portfolio to become more defensively if needed. And we're also holding a high cash balance. So we're ready to deploy this cash balance on any market pullback, which will always occur. We expect volatility into the coming year. Obviously, the macro and the outlook looks good, which means that investors are positioned for this. So if we have a slight wobbling growth, a pullback in US GDP data, there could be an opportunity to deploy this cash and invest into some stocks on some weakness. That's essentially how we're seeing things for the next year. Over the upcoming quieter period, unfortunately, the market never sleeps. There's a few days where the market's closed, but we'll be managing the portfolio around the break, and so we're here to chat if clients want to. So we hope you have a relaxing break with your families, and don't hesitate to contact us or anyone in the team if you have any questions before our next update, which will be out in early January sometime. Thank you.